Hey everyone, welcome back to Wealth for You. If you've ever opened your portfolio, saw red everywhere, and felt like you just swallowed a wasabi bomb, don't panic. Because today, we're talking about why markets always rise in the long run, and how dividend investing can be your steady laksa broth, warm, reliable, and comforting, even when the world feels a bit too spicy. Stay till the end, because I'll share how Singapore investors like you can use REITs, bank stocks, and dividend ETFs to build sustainable monthly income, and what risks to watch out for so you can protect it. And if you find this video helpful, please like it, subscribe to Wealth for You, and press the notification bell so more Singaporeans can learn how to be cash flow rich, not paper rich. Just a quick disclaimer. This video is for educational and entertainment purposes only. It does not constitute financial advice or a recommendation to buy or sell any investment product. Always do your own due diligence and consult a licensed financial advisor before making any investment decision. Chapter 1. What is dividend income investing? Dividend investing is really about letting your money work harder than you do. You buy shares of companies that share their profits with you. That's what we call dividends. Every quarter, half year, or year, these companies distribute part of their earnings back to shareholders in cash. It's not a bonus. It's your fair share of the profits for owning a piece of the business. Think of it like your favorite chicken rice stall. If you owned part of the shop, every day it earns money, you'd get your portion of the profits. You're not waiting to sell the stall for a higher price. You're collecting steady ka-ching income month after month. That's the beauty of dividend investing. You build cash flow, not just paper wealth. Even when markets swing up and down, dividends from solid companies keep flowing in, like a steady Kopio drip. Here in Singapore, that's why investors love DBS, OCBC, and UOB, or reliable REITs like CapitaLand Integrated Commercial Trust, Ascendas REIT, Frasers Centrepoint Trust, and Mapletree Industrial Trust. And if you prefer something simple and diversified, there are ETFs like the Amova Straits Trading Asia ex-Japan REIT ETF that automatically spread your investment across multiple quality income assets. These are the engines of Singapore's dividend ecosystem. Businesses that generate stable cash flow from real assets and strong operations, and that have a clear culture of rewarding shareholders consistently. Chapter 2. The why behind dividend sustainability. Now that you know what dividend investing is, let's talk about the most important part, the why. Markets and dividends grow because economies grow. As businesses become more productive, cities expand, and people spend more, profits rise. That same economic growth is what fuels your long-term dividend income. For dividend investors, the goal isn't to find the fastest-growing company, it's to own businesses that can keep generating steady cash flow through all kinds of markets. In Singapore, that means companies with durable competitive advantages, prudent management, and a clear, long-term commitment to rewarding shareholders. Think of our local bank giants, DBS, OCBC, and UOB. They're the backbone of our economy, making money from essential services like loans, credit cards, and trade financing. These are not one-off trends. They're core financial services people rely on daily. That's why their dividends have remained resilient for decades, even through recessions. Then we have the REIT heavyweights, CapitaLand Integrated Commercial Trust, Ascendas REIT, Frasers Centrepoint Trust, and Mapletree Industrial Trust. These own physical assets, malls, offices, logistics hubs, data centers, that tenants pay rent for year after year. And because REITs are legally required to distribute at least 90% of their taxable income, investors get a regular share of that rental income. If you want simple diversification, ETFs like the Amova Straits Trading Asia ex-Japan REIT ETF or similar broad-based income ETFs give you exposure to a basket of REITs, spreading your risk while still earning that steady cash flow. Of course, no dividend is ever guaranteed. Even solid companies can adjust payouts if business conditions change. But when you invest in quality names with resilient cash flow, you're stacking the odds in your favor. So instead of chasing the latest hot stock, focus on businesses that will still be standing, earning, and paying 10-20 years from now. These are the kopitiam owners who never close shop. Reliable, consistent, and built to last. That's the why behind dividend sustainability. You're not betting on hype, you're investing in resilience and reliability. Chapter 3. Why markets go up in the long run. So why do markets, and your dividend portfolio, tend to go up over time? Because behind every market index are real companies creating real value. When economies grow, businesses expand, hire more people, innovate, and sell more products. Profits rise. And when profits rise, share prices and dividends usually follow. If you zoom out, history tells a powerful story. The market has survived wars, pandemics, inflation spikes, and financial crises, and still kept climbing over the decades. Just like how Singapore's skyline keeps growing taller despite every storm. That doesn't mean markets rise in a straight line. Far from it. There will always be periods of volatility, corrections, recessions, even global shocks. But over time, innovation and productivity drive growth upward again. Think of it like a hawker center renovation, temporary mess and noise, but when it's done, business booms stronger than before. For long-term investors, this is the key mindset shift. You don't have to predict every dip or spike. You just need to stay invested so you're there when the recovery comes. Because the biggest gains often happen when things feel scariest, and missing just a few of those rebound days can drastically reduce your total return. So instead of worrying about when the next correction hits, focus on time in the market, not timing the market. The longer you stay invested, the more dividends and compounding quietly work in your favor, like kopi slowly dripping into your cup. That's the beauty of long-term investing. Short-term storms are noise, but long-term growth is the signal. Chapter 4. Don't panic during market dips. Market dips are like Singapore's weather. 1 minute blazing hot, the next thunderstorm. They may feel scary in the moment, but honestly, they're perfectly normal. Every investor goes through them, and they're really the price we pay for long-term growth. When prices fall, your screen turns red, and you feel like dumping everything. Pause for a moment. Historically, the market's strongest rebound days often happen right after the biggest drops. If you sell during the panic, you risk missing those golden recovery moments that drive long-term returns. It's like leaving the hawker center just before the best sauté skewers come out. You skip the best part of the meal. So instead of reacting emotionally, treat volatility like background noise. Remember, dividends from quality companies don't disappear just because prices dip. Your DBS, OCBC, or UOB shares still pay you. Your REITs, like CICT, Ascendas, Frasers Centrepoint Trust, or Mapletree Industrial Trust, still collect rent from tenants. Yes, payouts may fluctuate slightly in tough years, but the underlying business models remain resilient. Take that moment of fear as a chance to check your fundamentals, not to abandon ship. Because for patient dividend investors, downturns are usually temporary storms. And when the clouds clear, your steady cash flow keeps flowing like kopi O dripping through the filter. The takeaway? Don't panic during dips. Stay invested, stay calm, and let time and discipline work their quiet magic. Chapter 5. Build a balanced dividend portfolio. If you want your dividend income to stay steady through the ups and downs, you need balance. Just like a good meal has rice, meat, and veggies. Don't put all your money into one stock or even one sector. Even the strongest companies can face surprises. New regulations, higher interest rates, or changing consumer habits. In Singapore, a solid dividend portfolio usually includes a mix of banks like DBS, OCBC, and UOB for financial stability, and REITs such as CapitaLand Integrated Commercial Trust, Ascendas REIT, Frasers Centrepoint Trust, and Mapletree Industrial Trust for rental income from malls, offices, and data centers. And broad-based ETFs like the Amova REIT ETF or the STI ETF for diversification across many companies automatically. Each plays a different role. Banks thrive on rising interest margins. REITs shine when property markets are steady, and ETFs spread your risk across dozens of holdings so you don't depend on a single performer. Diversify by sector, geography, and even property type. Retail, industrial, office, healthcare, so no single shock wipes out your income stream. Because the truth is, even companies that once felt sure win, like Noble Group or Highflux, remind us that dividends are never guaranteed. A well-balanced portfolio ensures that if one area slows, another keeps your income flowing. The goal isn't just owning many things. It's owning complementary income sources that work together to protect your cash flow through any market cycle. Chapter 6. Turn downturns into opportunities. When markets crash, most people panic, but dividend investors should smile a little. Because downturns are like late-night hawker deals. Same food, lower prices. It's uncomfortable while it's happening, but for those with discipline, it's the best time to build long-term wealth. In 2020, when markets plunged during COVID, investors who stayed calm and picked up quality names like DBS, CICT, or Ascendas REIT at 30 to 40% discounts are now enjoying stronger dividends and handsome capital gains. That's the power of buying great assets when others are fearful. You're locking in future income at cheaper prices. The key is to prepare your shopping list before the storm hits. Know which high-quality stocks or REITs you want to own more of, and at what yield or price range. Because when the market falls, you don't want to be guessing. You want to be ready. It's not about timing the bottom, it's about being consistent and confident in what you're buying. If a REIT like Mapletree Industrial Trust or a bank like DBS is still generating strong cash flow, a lower price just means you're getting a better yield. So next time markets dip, don't let fear freeze you. Think like a value hawker hunter. Scoop up the quality dishes while they're still on discount. Chapter 7. Dollar Cost Averaging or DCA. The power of consistency. Now let's talk about one of the simplest, yet most powerful, investing habits. Dollar Cost Averaging, or DCA. DCA means you invest a fixed amount of money on a regular schedule, whether the market is up, down, or sideways. It's kinda like ordering your favorite nasi lemak set every week. Sometimes the price is up, sometimes down. But you still enjoy the same satisfying meal. By buying consistently, you automatically buy more shares when prices are low and fewer when prices are high. Over time, this averages out your cost per share, helping smooth out volatility and reduce emotional mistakes. In Singapore, you can automate DCA easily through monthly investment plans on various platforms. You can DCA into STI ETFs, REIT ETFs like the Amova REIT ETF, or even into your favorite blue-chip dividend stocks such as DBS, OCBC, or CICT. The magic isn't in perfect timing, it's in consistent action. Every month you invest, you're quietly building a bigger engine for future dividends. And here's the best part. DCA removes emotion from the equation. No more guessing when to buy or worrying about waiting for the dip. You just set your plan, top up regularly, and let time and compounding do the heavy lifting. It's steady, disciplined, and simple, just like how we enjoy our kopi every morning, not because it's exciting, but because it works. Chapter 8. Understand the risks. Here's the sambal chili, the part that can sting if you're not careful. Dividend investing may feel comforting, but it's not risk-free. The biggest danger isn't short-term price swings. It's a permanent loss of income. That can happen when 1. A company cuts or suspends its dividend because profits fall, or 2. When an entire sector, like REITs, faces higher interest rates that squeeze margins, or 3. Even a prolonged economic slowdown reduces consumer spending and rental demand. Even Singapore's strongest names, DBS, OCBC, UOB, CICT, Ascendas REIT, Frasers Centrepoint Trust, Mapletree Industrial Trust, are not immune. Their track records are solid, but dividends are never guaranteed. That's why diversification and risk awareness are your best protection. Keep an eye on factors that affect income stability. Firstly, interest rate cycles. Rising rates raise REIT borrowing costs. Next, gearing ratios. Too much debt can limit future payouts. Finally, regulatory changes. Property cooling measures or tax rules can alter profits. And don't chase the highest yield on the screen. High yield can sometimes mean high risk. Aim instead for sustainable yield, a payout supported by real cash flow and a healthy balance sheet. Because in the long run, the investors who last are the ones who protect their capital first. Think of it like cooking laksa. You want just enough spice for flavor, not so much that it burns the whole bowl. Chapter 9. Mindset matters most. At the end of the day, the hardest part of dividend investing isn't finding the right stock. It's mastering yourself. Your biggest challenge isn't inflation, interest rates, or the Fed. It's emotion. That voice in your head that panics when prices drop and gets greedy when they rise. Successful investors don't need superhuman intelligence, just discipline and patience. They don't check their portfolio every hour. They focus on collecting reliable dividends month after month, year after year. So instead of chasing quick wins, stick to your plan, your monthly DCA, your balanced portfolio, your focus on quality. Think of it like your favorite bak chor mee stall. You go back again and again because it's consistent, not flashy. Because true wealth isn't built in a week or a month. It's built quietly over time through habits, patience, and compounding. Stay invested, reinvest your dividends, and let time do the heavy lifting. When your cash flow grows strong enough to cover your life's expenses, that's not luck, that's freedom. Final thoughts. Building cash flow freedom. At the end of the day, dividend investing isn't just about chasing high yields or fancy charts. It's about peace of mind. It's about knowing that every month your portfolio is quietly working for you, sending you kopi money that slowly grows into kopi sigaw money. That steady income gives you freedom. Freedom to choose how you live, where you work, and when you rest. And remember, wealth isn't about owning the most things. It's about building cash flow that lets you live life on your own terms. That's what being cash flow rich, not paper rich, really means. So if this video helped you understand dividend investing a little better, please give it a thumbs up, subscribe to Wealth for You, and press the notification bell, so more Singaporeans can learn how to build sustainable income and financial freedom together.